Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, and one of the co-founders of the Dividend Kings marketplace service here on Seeking Alpha. And this is actually a follow-up article to an article that I wrote where I talked about Microsoft, Visa, and Apple. And I kind of indicated, were investors crazy today to own them, or were they crazy like a fox? Because as I pointed out in the article, these are three of the favorite companies on the planet, my favorite companies on the planet. Actually, I have made a lot of money in all three of them. I will admit that I've sold all of them, and I have left money on the table, but I made a lot of profit, and I never regret making a profit. All I tried to do with the article was point out to people that these stocks have actually become very, very expensive relative not only to historical norms, which people tend to want to focus on, but also to the reality of the fundamental value that their future earnings and cash flows actually indicate. Well, you'd have thought I basically were attacking their children or, just really being insulting to them. And of course, there was no intention to do that. I was simply trying to be a nice guy, because I am a nice guy, and trying to point out that these stocks were actually getting pretty expensive. So I wasn't saying you should necessarily sell them, but I did want to warn people, be careful about adding new money until you get a better opportunity, a better entry point, because I do believe that eventually that, prices, valuations will revert to the mean fundamental valuation, which is based on what the intrinsic value of the company rather than its market value. Short-term values can go anywhere. In the long term, fundamentals do rule. So anyway, let's take a look at this article. And what I'm going to do is go over some examples I showed here, because this whole article ended up in the comment thread debating the reality of whether interest rates have a general effect on prices or not, and whether or not all three of these stocks, and Microsoft became the one we talked about the most, were actually attractively valued because interest rates were so low. And of course, I argued against that. So here are some examples of why I don't believe that interest rates justify these high valuations. So let's go ahead and start with our first example. In the article, I pointed out NetApp, or the old network appliance, because I thought this was a great example to show how earnings determine market price. I also felt this was a great example that can illustrate how stock prices can get completely out of touch with intrinsic value, and how ultimately interest rates and stock prices don't always move in an inverse relationship as many, many people believe. So let's start by looking at the tech bubble, which goes back here to September of 2000, when NetApp's stock price or valuation was trading at just under 500 times earnings, 497 times earnings. And then, of course, if I click that, you can see that that culminated, from September of 2000 to September of 2002. That led to a 94% drop in the market value of the stock. Now, this had gone on for a couple of years before, which I don't have available on the graphs. I don't go back that far. But the point is that this was a 3 or 4 year period where the stock price didn't really reflect intrinsic value. But that was followed by another 4 or 5 year period where stock prices once again didn't reflect intrinsic value. And of course, it was very hard to convince people that the stock had become dangerous. But I do want you to notice it lasted for several years here before we finally got from its peak valuation again. We got another major hit where this time the stock fell 62%. And of course, that was the Great Recession. But, as I said in the written portion, when you fail to learn the lessons of history, they tend to repeat themselves. Well, once again, the stock gets significantly overvalued. And once again, we get this reversion to the mean. This time, it only took a year and a half. Then we saw stock prices follow earnings, very, very closely, and the company did initiate its first dividend in April. By the way, the orange line in this graph would represent intrinsic value based on a 15 PE ratio, or an earnings yield of 6.67%. You can clearly see that in the long run, the stock price does track that, and when it does get disconnected, even when it gets undervalued, where the market overreacts on the downside, we normally get this back to intrinsic value reversion, if you will. And then the market can get very emotional, get high valuations again, then we get these low valuations again. So the bottom line is that in the long run, earnings determine market price and fundamentals do rule. But, there is this notion that there's an inverse relationship between stock prices and interest rates. And I bought that, by the way. I bought that for many years. In fact, I bought it so much that I actually created a graphic within my FastGraph tool that literally plotted PE ratios versus interest rates. So what you have here is the 10-year Treasury, and I'm going to take the PE ratios off. That's the blue line. So this is the 10-year Treasury note. You can see that it went from 6.29% steadily down to 0.65% as of August 31st. So here's clearly an extended period of time with the typical volatility in between, where interest rates were steadily dropping for, the better part of 20 years here. This blue line is year-end PE ratios. Now here we have this, very, very high PE ratio. It's a slightly different time frame than I showed on the historical graph, where the year-end PE ratio was 350. Then it dropped down to 72. Then it did rise again, by the way, and here inconsistent with the theory where interest rates were dropping, but yet from the PE ratio of 145, back here in 2002, all the way through current, we've seen a steadily falling PE ratio for a network appliance. It currently trades at about 11 plus times earnings, blended PE ratio we call it, and it got down to 10.31 by year end last year. So here we had interest rates and PE ratios falling in tandem. The point being is that that defies the conventional wisdom that there's this inverse relationship between PE ratios or stock valuation and interest rates. So lower interest rates actually lowered the value of network appliance. The next example I used was one just to illustrate the relationship between earnings and stock price. I'm using General Dynamics. Once again, the orange line represents an intrinsic value of 15. We see the stock price, tracking that. We do see an extended period of undervaluation coming out of the Great Recession, followed by overvaluation again, and then we had this eventual reversion to the mean. And again, sometimes these things last a long time, sometimes they last a relatively short period of time. But in the long run, it becomes clear that the stock price will inevitably revert to the mean. So now when I go to the PE interest rate graph of this particular company, we see a very interesting relationship, which I wrote about in the article. Initially we had this moving in tandem. Interest rates and PE ratios were dropping together. Then we had a period where interest rates actually rose, from off of a low of 1.59 up through just a little over 2.5, and yet we had PE ratios rising along with it. So these rising interest rates, if the theory is correct, should have spooked the valuation of General Dynamics, but it didn't, because what happened was General Dynamics actually generated more growth during this period of time, which actually caused the valuation to be higher. So the PE interest rate relationship does have some validity, ceteris paribus, all things being equal, if everything was common. But in the last 20 years at least, that relationship has been very, very challenging. There really hasn't been a direct relationship between interest rates and stock valuations. My next example was Walmart, which I find a very, very interesting story, because what I pointed out was Walmart was a stock that became very highly valued relative to its earnings growth. Again, the normal PE, or the intrinsic value PE, should be 15. The stock was overvalued, and it stayed that way, and I actually measured it in the written portion all the way out to here. But I want to point out that just before the Great Recession, the stock did revert to the mean. But this took 6 or 7 years for that to happen. But during that period of time, you would have lost 2% a year annualized on your money, and that included the dividends. Your $10,000 original investment, using that as a kind of a metaphor, would have fallen to $7,969. You'd have picked up $635 in dividends, because Walmart, paid and increased their dividend every year during that time frame. But the net result was you ended up with, including dividends, $8,600, or a 14% loss, or total, rate of return loss, or an annualized minus 2% a year. But yet I do want you to notice at the bottom of the graph here, Walmart grew at 9%, 6%, 21%, 12%, 19%, 10%, and 9%. This was very excellent growth. The company did great. They raised their dividend every year. The shareholders did poorly, but valuation was the culprit. Now, if we go and look at the P equals interest rate graph on Walmart, we once again see a very interesting situation where the PE ratio, the blue line, actually dropped in tandem with the interest rates as they dropped. So the idea that low interest rates are going to justify higher valuation doesn't really hold a lot of water, at least in my world. Now, in the article, I talked about some additional thoughts. I talked about Microsoft, and I tried to point out Microsoft was very similar to Walmart. It had a very extended period of time of very poor performance, even though the business actually did great, and that's something that's people don't understand. But I do believe the valuation has gotten out of line. The growth rate has accelerated, but if I look at forecasts going forward here, estimates are for really strong growth, over 13% a year. But that only really warrants about a 15 PE. It's fast growth, but it's not that fast. You could even argue a slightly higher PE, even if it was an 18 PE, which is more than the company's growth rate, you'd still have a potential loss on this stock. So the point is, the earnings growth does not necessarily justify the rate of return. Now, I showed you forecasts from Yahoo Finance, which I can go directly to with Fast Graphs. I also showed you forecasts from Seeking Alpha, which they get their data from Standard & Poor's. We get it from FactSet. And the point is, all those estimates are within a few pennies of forecasting the same dollar amount of earnings over the next couple of years. And again, I don't believe that justifies the current valuation. So now if I go back to the history, which I did in the article as well, and I look at Microsoft and I look at it from a standpoint of its earnings growth, this stock has been misappraised by the market most of the time, and it always ended up badly. The PE ratio back here was 47, okay, so that was high, but it did get down to, roughly about 25 here in December of 2000, and again, that led to a decade of loss, roughly, from late 2000 through 2009, we had a negative rate of return, even though the business did good. Once again, look at the earnings growth. We had very excellent earnings growth, and then we had some flatness going on, and Microsoft was trading actually at 9 and 10 PEs, and I'm not saying it's going to go back to a 10 PE, but I am saying that it could, and the point is, this has been a great ride. This has been an awesome performance. The company has turned itself around from the standpoint of it's generated some really nice numbers here lately, and I even had a comment talked about the company's cash flow. Operating cash flow has also grown very, very nicely for this company over this time frame. But again, I don't think any of these numbers justify the current valuation of Microsoft. It's just simply too high. I'm not trying to be a bad guy here. I'm just trying to alert people to the reality that this is a very, very high valuation. And frankly, this valuation is not really justified by the valuation, despite what interest rates are. Because once again, we can look at PEs and interest rates, and we can see that the PE and interest rates fell in tandem for well more than a decade. But the PE has been increasing recently, and that was during a period when interest rates actually were showing some signs of rising. And now that we have had this big drop in rates, we do have this rise in the PE, but that relationship has not always existed. Now, just to drive this point home, then I also showed USANA Health Sciences, a company that has no debt. And the point was that, interest rates aren't really impacting this company because they're not borrowing any money. Okay, it's a great growth story. Their average growth has been 17%. I pointed out in the article that if I tracked, the PE was trading at about equal to its growth rate, 17.3 versus 17.3. So that's the intrinsic value of this stock because it's growing at 15% or better. I'm using a PE of 17 here, not a PE of 15. And you can see the stock price track that. And in reality, the shareholder ended up making about what the company generated on their behalf. Nevertheless, kind of staying true to our theme here, if I look at P equals interest rates, we had falling PE ratios and falling interest rates moving in tandem. And then we've had, rising PE coming out since 2012 or so. And the reality of it is when I look at that from a standpoint of earnings growth, we see some cyclicality. The point is what's happening to this orange line, and if it's a dividend paying stock, the light green shaded area and the white dividend line are going to have a lot more impact on what the valuation is going to be than if you are, looking at a stock that has no debt like USANA does. But anyway, that's about as far as I want to take you. I did go a little bit more into depth on Microsoft. I also showed you another company with high debt, AbbVie, that actually grew more. But just to keep this video short, the whole point is that I do believe interest rates are something that should be considered. Okay, but I don't think they change the intrinsic value of the company. What you're really trying to decide is, are you looking at an opportunity to invest in an equity like a General Dynamics that you can buy at a reasonable valuation with a nice dividend yield versus investing in a fixed income investment? That makes sense. But I don't believe it justifies paying extremely high valuations for companies when their growth doesn't warrant that. That's the main point that I was trying to get across here with both of these articles. Anyway, I hope you enjoyed it. Hope you learned something. I've enjoyed presenting this. It's a subject I'm obviously very passionate about. If you like this kind of work, you might want to take a look at the Dividend Kings here on Seeking Alpha. For those of you who are looking for good dividend growth investments where you can get a steadily rising income, we think it's a great service for that. You might also ring the bell and follow me on YouTube as well. Anyway, this has been Chuck Carnevale saying thanks for watching.